Without further delay, let me pass to our next panel, which is going to be a roundtable discussion, which is going to be moderated by Nina Chestney, an expert journalist in ESG. So Nina is the head of power, gas, coal, carbon, renewables for the EMEA region at Reuters news agency. So Nina, you're going to have a wonderful panel, and thank you very much for joining us.
Thank you. Thank you for inviting me. Hopefully you can all hear me. Just a quick sound check. Yeah. So welcome to this panel on green markets, greenwashing and sustainable reporting. As he said, I am the head of basically everything except oil at Reuters. I've been covering climate change, sustainable investment and green markets for quite some time. And so I'm pleased to have an array of wonderful speakers on this panel, and it should be really interesting, actually. I'd like to start by asking the panel participants just to give a quick introduction of themselves so that the audience understands their background and the companies or organizations they represent. So maybe over to you, Sue, first.
Thank you very much, Nina, and thank you for hosting today. I'm Sue Lloyd. I'm Vice Chair of the relatively newly created International Sustainability Standards Board as part of the IFRS Foundation. So we're working on our first 2 standards to establish a global baseline of information for global investors on sustainability risks and opportunities. And prior to taking up this role, I was Vice Chair of the International Accounting Standards Board. Thank you.
Great. How about Laurent?
Yeah, hi, good afternoon, everybody. I am Laurent Babikian, global responsible of data product at CDP, and CDP is the largest environmental reporting platform in the world, and we give back this data to what we call the signatory investors. We have 750 of them, so that they can work more precisely on the E part of ESG. We deal with the E part, environmental data. Thank you.
Thank you. And Nikolaos?
Hello, everyone. Thanks for the invitation and for hosting this event. I'm Gkonis. I'm the head of ESG department of Prodea Investments. Prodea Investments is the largest real estate investment company in Greece, with assets under management around 3 billion euros. We are dealing with everything regarding ESG reporting and energy services in the group. And happy to be here and join the panel.
And last but not least, Panagiotis.
Hello, everyone. Glad to be here and share with you our thoughts. I'm the Senior Sustainability Director for Viohalco group of companies. We are active in metals processing in various countries across Southeastern Europe, the UK, employing over 12,000 people in the industrial sector. And being in the metals processing industry, I think we are right in the middle of environmental impact. So I'll be glad to share with you our thoughts on that. Thank you.
Great. So just for the audience, at the end of the session, we'll have 10 minutes for your questions, which I'll direct to the panelists. We'll kick off with quite a broad question, really, for everyone on the panel. I mean, the sustainable investment market is worth over $35 trillion by some estimates, but that depends on how you define or categorize a sustainable investment, I guess, which is quite a big topic for this panel. But what do you think we need from capital markets for more growth to happen in sustainable investment over the next few years? Not sure who wants to kick off on that. While you're here, maybe you start, from a company perspective while you've got the camera? Panagiotis.
I'm sorry, the question was for me because
Yeah, I mean, you might as well start, seeing as you're
well,
on camera.
Well, I think that from a financial point of view, what is important is that the financial institutions, it's very critical that they maintain credibility in this day and age where sustainability is such a buzzword in consumers and media and the regulators, and everybody is so willing to show that they're doing so much. I think the financial institutions need to have a better understanding and look at the material issues, be able to distinguish what is material for, let's say, a metal processing industry, for the communications industry, for a bank, for whatever the impacts are different. So in order to finance the companies that are acting responsibly and they're moving in the right direction and they're looking after their supply chain properly, they need to have a good understanding of what is material, what is not, have a robust methodology for monitoring and seeing their performance over time.
Okay. Laurent?
Yes, I mean, first of all, I think we need to have a clear definition of what a sustainable investment is. Then we need to have many more companies really doing ESG, a good job at ESG with some, science-based target, for example, some clear transition plan, and we don't have enough company, so that investors can easily pick some stocks rather than other stocks. If I look, for example, at the science-based target, I think we only have 2,000 SBT approved target for companies with 1.5 degree target, which is clearly not enough for investors to select investable universe. And also because the question is, how can we increase the flow in terms of sustainable investment? I also think that there is a huge lack of innovation on the financial market. And I think that we should have all the bricks of the plain vanilla market. I'm thinking of the options, swaps, futures apply to ESG so that it can create the conditions and the conditions of the liquidity for all the market players to do their job. And specifically, hedgers, speculators and market makers, and people will speculate against ESG, but that's part of the game if you want to create liquidity. And we don't have this innovation, so it's clearly lacking. And yes, that would be my first responses to this question.
Sue, would you agree with Laurent, or
Yes, slightly different perspective, although I don't disagree with anything that's been said. But I think one of the key things that we are thinking about at the ISSB is really making sure that there's the information that enables investors to be informed, to form a basis for decision making. So I've even set aside the sort of whole question of what's a sustainable investment and what's not a sustainable investment, which I'm sort of lucky enough at the ISSB not to need to determine. I'm about making sure that there's transparency about the risks and opportunities that a company is exposed to, how they're managing those, what their strategy is, and sort of what their prospects are, taking into account those risks and opportunities. So if I then look at that and think, okay, so our focus is making sure that investors can be confident that they have the information to really feel they understand sustainability risks and opportunities and what it might mean for an investee or a particular investment that they're looking at. And so even if I set aside the investors who have a particular focus on, particular types of sustainable investments, depending on how they think about that, all investors want to make sure they really feel they're confident, they understand the risks and opportunities to inform their decision making. And I think if we start off with better information about sustainability risks and opportunities more broadly, we're creating a safe environment, if you like, for investors to feel they can make informed investment decisions and allocate their capital in the way that their preferences are. It also means, because we ask for information about, if I look at climate, things like what's the company's transition plan? what are its opportunities it's exposed to? It's really giving the opportunity for companies to communicate and to showcase where they are an attractive investment or why they'd be a good candidate if you really are looking specifically for a particular type of sustainable investment. If you're interested in renewals, if you're interested in a company that's managing emissions in a particular way, you can see that. And therefore that enables the investment decisions to be made. So I think from my side, that just basic sort of hygiene factor of robust information where you can really be confident you've got the information you need and make valid comparisons between companies across jurisdictions is a real key to unlocking that sort of flow of investments.
Okay, and Nikolaos, what would you say in response to that?
I'll try to bring a more positive approach to the discussion. I think that if you had made this similar question a few years ago to an expert working in sustainability field, you'll find it as a great opportunity to stand up for sustainability and persuade the audience about the hidden opportunities of this market. I think that we are not there right now. This volume that you mentioned about 35 trillion comes after a steady upward trend, and the last 2 years we saw an increase of around 15% of this market. So following the same methodology of how we calculate the numbers, I think that we are going to see the same trends over the next years. Investors and corporates have started to understand the importance of ESG factors, and they're aware of that sustainable investments becoming the business as usual case, while the risk of the non-sustainable investments is already really high. Now, if I have to point out 3 things, let's say, for the further development of this market, I would choose the transparency, accountability, and the harmonization of the disclosure framework. I'm sure that everyone and every investor needs reliable and accurate information in order to make informed decisions. As a second point, I would say a strong regulatory framework that, especially in the EU, is something that is evolving constantly and will have it during the next years. And of course, education and awareness in order to succeed higher levels of stakeholder engagement in all sectors.
Okay, thank you. I mean, we've a lot of in fact, you all really touched on the idea of what is a sustainable investment, and that is quite a big issue. And greenwashing has played a part in making that become a bit of a problem in sustainable investment environment. The EU Commission this year introduced new rules to crack down on this through their Sustainable Finance Disclosure Regulation. I'm wondering, maybe for Sue and Laurent to answer at the beginning, maybe, what has that made it easier to ascertain what are genuine sustainable investments or not? And does more need to be done to crack down on that, to give clarity for investors and also governments and the public? Laurent, do you want to start on that, maybe?
I can definitely start. I would like to start first by saying that we need ethics in the process. When you have a net zero alliance and you do that for marketing reasons, and in the facts you don't follow behind, then there is a problem of alignment between the objective that you want to do and what you are really doing today. And so we really need to bring back ethics in business. That's first point. Second point, yes, it's true that at the EU level, there is a bunch of regulation coming. The SFDR is one, but is linked to another one, which is CSRD. And the SFDR has the clear intention to kind of create categories for investment funds. And you can be Article 6, Article 8 or 9. And then for each of them, you would have to do to follow some rule and to disclose them Then there is the question of the interpretation of the rule by the regulator in each country. So you can have an interpretation of one rule in France, which is going to be different from the regulator in Luxembourg, which can create a problem. And we see clearly now in the making of this SFDR regulation, we see clearly that there is still a lot, there is a big room for greenwashing, for example, in two ways. The first way is when an investor invests in a company and then we don't have any threshold about what is green and what is not green. And an investor could claim that investing in a company that says that has 20 or 30% or 60% of its revenue green, what is the threshold above which I can claim as an investor that I invested in a green company? We don't have this. So we need to have this determined somewhere. We don't have, again, the definition of what a sustainable investment is, and we saw that it created a lot of turmoil on the market because a lot of investors were asking, give us a definition. And if I come back to the example I gave, if a company, let's assume that the company has claims that the company has 50% green revenue, what about the other 50%? Do they significantly harm all the other environmental objectives that could be, biodiversity, water, oceans, pollution, or not? And what are the thresholds above which or below which I can claim that it is harming or it does not harm? We need to have those kind of granularity to be able to claim that my investment in this company is green, and then at the portfolio level, the same logic goes on. And my third point is that next to SFDR is CSRD. By the way, there was, kind of timing mismatch between the two. The CSRD should have been launched before the SFDR, but that's the reality. CSRD will start next year. And CSRD will provide, there is a bunch of new data coming on the market, which will be reported by 55,000 companies following the European ESG reporting standards. And this data will be audited. So for the first time at a very big level, you will have audited data, a bunch of new audited data coming on the market. This will reduce also the opportunity of greenwashing, to have audited data and to have data following the same framework and using the same ESG reporting standard. This is why I think we will have this discussion later on. There is a clear need of harmonization of the ESG reporting standard around the globe. That would be my first three answers.
Okay, thanks, Laurent. And Sue, do you want to pick up on that as well?
Absolutely. So I can build on where Laurent ended, actually. It's a good point of entry for me. So I think, it's always hard to come up with a sort of description of what's sustainable or not sustainable because people have different opinions and it's quite complicated. And Laurent was touching on some of the complexities of that there. But I think one thing that is really a common factor, no matter, where an individual's views lie, is that you want to be sure that you really understand what's going on. And at the moment, the situation we've had up until now has been very much a sort of situation where there's a lot of information about sustainability risks and opportunities, but it's being provided mainly on a voluntary basis and mainly using a whole different combination of different frameworks. And that means that we've got a situation where at the moment that even with, the best of intention, we can have companies providing different disclosures that can make them look, the same when they're not the same or different when they're not really different, just depending on what it is they emphasize in their disclosures. And it makes it really, really difficult if you're an investor who really is trying to seek an investment with particular characteristics to be confident you're actually investing in the thing that you think you're investing in. And so I think what's critically important and what both we are trying to do at the ISSB and what ESRS is trying to do, the European Sustainability Reporting Standards that are part of this regulatory package is trying to do, is to make sure that we have got more robust information, that it is comparable between different entities. So you can really genuinely identify that if there's different information, it should be a true economic difference as opposed to somebody just chose a different disclosure. And for me, that's our first best defense against greenwashing, really having true comparability to really identify true economic similarities and differences, just not just disclosure differences. And as Laurent says, if in addition to, having disclosure requirements, which are comparable and prepared with the same sort of rigor as financial statements, which is what we are certainly working towards at the IFFR-EBRD, if that comes along with assurance and regulation and auditors and others involved, it should just mean we've just got that more robust environment to form the basis for these assessments about whether investments are sustainable or not.
Okay, thanks, Sue. That brings us nicely to move more into the realm of sustainable reporting. I'm wondering whether the value of science-based ESG, which Laurent mentioned earlier, is being incorporated enough into corporate sustainable reporting and the guidelines around that, and how companies can navigate these many different standards and methodologies that there are around for reporting. I appreciate there are efforts to streamline this, but we're not there yet. Maybe Nikos, do you want to talk about the problems for the companies, for companies like yourselves navigating all these different things when you're trying to report in this way?
Yes, of course. It's true that including also the sector-specific ones, there are plenty of standards, guidelines, frameworks for sustainability reporting, leading to fragmented and sometimes confusing landscape. Now, from the implementation point of view, after this navigation that you mentioned, the usual case is that each organization choose the most good, let's say, for each organization reporting standard, what fits better to their needs and the needs of their stakeholder, and start reporting according to these. All these before the new CSRD and before the new ESRS, let's say, that's here to change the whole picture and bring a series of changes, not only in the methodology that we're working till now. I hope that these will remain a bit the same, but definitely change the time schedule of our work and the involved parties that we'll need in order to do our work. Now, talking about the science-based ESG that you mentioned, CSRD demands specific greenhouse gas emission reduction targets for 2030 and 2050, based on scientific-based evidences. Personally, I think that before setting any realistic in the beginning target and then science-based one, you need reliable data and to overcome the barriers and the problems that we usually face collecting all this data. For our case, and for having this amount of assets, which are non-controlled assets, so it's a scope 3 greenhouse gas emissions. It's a very painful procedure to collect all these data and be able to start setting up our strategy and follow the work plan that we set up. So this gives me the opportunity to point out that even there is a quite range wide regulatory framework regarding greenhouse gas emissions reporting, targets, science-based evidences, and all this. There is an absence of any regulation that help us to overcome barriers regarding sharing data across the value chain of an organization. So this okay. Actually from my side.
Great. And Laurent, do you want to pick up on that maybe from your side?
Yeah, I mean, I wanted to say that obviously the scope 3 will be one of the data that you will have to report to with the CSRD. So you will have 55,000 scope 3. So And we cannot say that there is a forever discussion, there is a lack of data, there is a lack of data. Yes, there is a lack of data, and you have model, you can model your data, and then you need to act, and you need to invest. I very often hear that company complain because there are lots of regulation, it's a heavy cost, and they need to, it's a lot of money. No, we don't need to consider that as a cost. It should be considered as an investment for the future, to position ourselves in the future, to be ahead of the wave of the transition to net zero and to a regenerative world. And the best placed company will be the companies which are ahead and envision this as an investment. And also, I wanted to say, even though there are lots of regulations right now and lots of framework, there is a tendency now to kind of harmonize. There is ISSB on the one side, the most two famous are ISSB and ESRS in Europe. Europe is covering also more than climate. It's covering biodiversity, it's covering pollution, it's covering water and oceans, and it's covering also circular economy. All these norms are ready to be published at the end of June. We see there are lots of debate right now, and we will see what will be the effect of that. But what is sure is that when you respond to the 20,000 company responding to CDP, the CDP platform, we are supporting any kind of framework, and the goal will be to support all the ESG reporting standards available in the world, so that investors can, as an output, get a lot of data from those 20,000 companies to be able to compare them, this data is harmonized, and they can compare them by geographies and by sector. So the job CDP is doing is to try to streamline this and to try to harmonize that, and we will support. We made an announcement with ISSB that we're going to be ISSB compliant in 2024. We will most probably make some more announcement in the future, because we need to support all the geographies and all in the world, because that's the goal of CDP. And obviously the companies they have multiple presence, multiple supply chain. It has an impact in Brazil, in Asia, in Latin America. So we need to streamline that, and a very good way to make such an analysis is to use this data through the CDP platform.
Okay, thanks. I'm aware that we need to leave some time for questions. So on the implementation side of any sustainable investment reporting, maybe Panagiotis, if you probably have quite a good insight on this. I'm wondering whether companies probably, have mixed and often contradictory messages from their customers, the investors, and then the regulators about what is a green or sustainable investment. And also an interesting question, especially, I guess, for your company, is how you incorporate, supply chain emissions into calculating your carbon footprint or the carbon footprint of a product. Is that something that's being incorporated enough into kind of sustainable reporting or not, do you think?
Well, the fact of the matter is that one of the main reasons there's a critique of ESG and ESG approach is exactly that you don't quite represent the entire impact of your operation or the product you deliver if you don't look at the whole life cycle. So just delivering, when you look at a car and you call it green, well, how was that car produced? Do you go back to the supply chain? Was this produced with alumina from the Uyghur region? Was it produced with the battery with cobalt from the DRC? You need to have a whole life cycle perspective. Now, we're coming from a place in the value chain where over 80%, in some cases up to 95% of our entire impact comes from the supply chain. So for us, it's extremely critical to represent that. It's important to give that to our customers, to our investors, and we rely upon them. Now, going back and to a couple of points that have been discussed before. Mrs. Lloyd referred to it as a critical era and a critical need to have a robust methodology. I could not agree more. The biggest problem we have right now is that, and there is an immediate need for a transparent to correlate that with ethics, because transparency is a key word here. And I think more so than ever, transparency can really make companies change the way they operate, and hopefully CSRD will move in that direction. So we need a robust methodology, so everybody has to meet the same criteria. Now, what happens in the public domain is one thing, what you tell your customers is another, because customers, they apply a lot of pressure on us, because being a B2B company, they want to go to their customers, to maybe on a retail base, and say how green they are. And frankly, if you just walk into any supermarket, you will get an overdose of green packaging. I can assure you that not everything is 100% recyclable. In fact, I would contend that the biggest greenwashing phrase is 100% recyclable, okay? Because it's not as simple as it seems. Just because it's made out of paper and plastic and it's glued together, this does not make it recyclable, just because it's paper and plastic. So we need to pay a lot of attention and make sure that, and then that's where the greenwashing directive comes into play, to make sure that companies are accountable for what they report. And one more thing to correlate that with sustainability investing and the taxonomy. Sure, it's in the right direction, but the taxonomy does not have the granularity approach that we would like to have. So you can have a sustainable activity, which would be a great investment, a windmill, a wind farm. Well, how do you know if it's sustainable if you're using steel that is super high carbon? I mean, you look at, taxonomy looks at steel, they look at aluminum as a raw material, and then they go all the way down to the actual product and the activity. But you know, what if that electric battery, that EV battery, what if the steel that was used for that car that is considered sustainable is not exactly sustainable? You know, we're missing that link. So we need further granularity in order to make the decision whether that is a sustainable investment or not.
Okay, that's good. Yeah, very good points there. There is actually a question in from the audience, which is similar to one I had also in mind, which really is around how we make money, or how the market makes money from sustainable investments. The question from the audience, an audience member, is it may well be the case that sustainable reporting does not help investors make money. And so therefore, what is the role of sustainable reporting? My question was similar, but how the impact of how sustainable investments can be properly converted into returns for investors. So I'm not sure whether Sue wants to, maybe Sue might be able to answer that primarily.
Sadly, I'm not an investment professional, or be much richer than I am, but I can comment on sort of the investor perspective and the opportunities, I guess, that come from the sustainable investment as we look at it. I think the first thing is to say that it's really important that people understand the risks, so the downside risk, if you like, of investments in the first place. So if you're investing in a business and it's going to be subject to regulatory change or reputational change, that means it's going to have to fundamentally change its business model, you need your eyes wide open going into that investment to understand what the future consequences of that could be. So I think there's a risk side of this as well. But then there's an opportunity side. I think it's really important for companies to be able to communicate opportunities to investors as well. And Laurent put it well, that it's really an investment. I think often when I talk to people about being asked to provide information about sustainability risks and opportunities, they think, oh my gosh, compliance, cost, and they see all of that side of it. But the way that we're drafting our standards is to enable communication with the market. It's to enable a company to explain why it is a good investment opportunity relative to others, because it has thought about its full life cycle properly, to Panos' point, that it has been thinking about how to manage its risks. It's got a smart strategy for how it's going to manage its business in a very increasingly regulated environment. If you're a company operating in Europe and you're going to be subject to a lot of regulations and requirements to meet net zero targets, you better have a strategy for how to deal with that. And some are going to be better than others. And for investors to have the visibility that they can rely on with good investor targeted information that they can really rely on, I think really enables them to make those investment decisions. And increasingly, we're seeing situations with, prudential regulation for the banks, for example, where to be able to make these investments, you really need to have a good understanding of what the sustainability risks and opportunities are, because you're going to need to report to prudential regulators and others to be able to make particular types of investments.
Okay, thanks, Sue. Does anyone else want to chip in on an answer to that? Lauren?
Yeah. I mean, I would like to first to say that there are now many studies showing that ESG doesn't kill financial performance, much on the contrary, right? It's a good ESG, not greenwashed ESG, increase the financial performance of portfolio. So that's basically now a fact, and you can go, can Google, and you have a lot of literature on that. The second thing is that I think that if we are serious about the net zero target, and more than net zero is a subsegment of something which is much bigger, which is to create the condition of a regenerative economy. If we are serious about these targets by 2050, then we also need to change the way we envision and the way we assess the performance of an investment in capital. We cannot use the recipe of the past to do something which is huge, that needs to be done. The transition is huge, is massive. It's so huge that the people are still unconscious about what it represents. So we need to find some new recipe, a new way of doing things, new macroeconomic indicator, a new financial indicator. And I'm thinking about one indicator, which is the return on impact. Because if I take the example of CSRD will ask a lot of questions about biodiversity, about plastic, about social, about governance, everything. And in quantitative question, we will be able to calculate impact on biodiversity, impact on water, impact on the value chain, I mean the circular economy. And the question is, how do we convert impact into dollar or into euro or into pound? And that's when we have the cost of externalities, negative or positive, mainly negative externalities, that will enable to convert this impact into something that we call the return on impact. And at the end of the day, you will be able to add this return on impact to the traditional return on equity. We cannot do a regenerative economy to create the condition of a regenerative economy by only using the return on equity. That's the old world. Things have to change. So if you add to the return on equity, the return on impact, you have a new way to assess the performance of an investment, and you have a new way to also value companies on the stock markets. Today, just for an example, and it's absolutely crazy what's going on today. Apple, the company Apple, is worth 2.8 trillion. To give you some perspective, the French GDP is $2.8 trillion, 2.6 euro, $2.8. And when Apple is worth 2.8 trillion, it is worth more than the top 40 French companies. So you add Total, LVMH, L'Oreal, you add all of them, you have less than Apple. So everything that we've been discussing now in this meeting, and all the regulation that is being implemented in Europe, is to try to have the price of a company on the market equaling the value of the company, which is absolutely not the case today. And we also, to do that, we also need a new way to assess things. And for example, what I just said, the return on impact will help. The cost of negative externality, to have a carbon tax, would help. This is why we don't have it, we know, but because it destroys shareholder value. And we also need the third pillar, which is a true cost accounting that would take into account not only the financial capital, but the human capital and the natural capital. In a profit and loss account, in a balance sheet account, you would be able to have some provision to amortization of human capital or natural capital. So we need all this to be able to build the necessary framework to do the target, which is a regenerative economy. That's what I think.
Okay, Thanks, Laurent. Another question from the panel, which is interesting actually, is around checking or the reliability of data sources and the integrity of that data that companies use for ESG reporting. How do stakeholders know that the data collected from companies, CO2 emitters, are actually accurate? I know that Laurent mentioned earlier that there will be an auditor for some new EU regulation, but that isn't a global thing, that's for the EU. So is there anything, I mean, how do we align that? You know, we can't compare an India CO2 emitter to maybe a European one that has more stringent guidelines. How do we know about the reliability of the data that's being used, that's being collected by them and presented? I'm not sure who would like to start.
I can comment on this one if you like, Nina. Nina, would it? Yeah. I can comment on this if you like. So yeah. So yes. So it's a really important question, and a couple of points on this. So firstly, we're working very closely with the International Assurance Standard Board, the IFFR-EBRD. So one of our regulatory counterparts who are about to publish an exposure draft, which is developing assurance requirements or practice that is suitable to support the assurance or audit of sustainability information. So there's already guidance out there in the market, but they're developing now very tailored guidance to support this. And certainly we are super interested in that, and really will be encouraging those who use our standards from a regulatory perspective to think about assurance, because it's part of the making this a reliable package of information for people to rely on. But the reality is there will be estimation. So there can be assurance about sources of information, etc. But there will be a need for estimation, because it's just not practical to expect that we're always going to have direct measurement of everything. And the first thing to say is there's a lot of estimation in financial statements. That's not a problem in itself. But what is really important is that investors understand what has been done. So one of the really important parts of what we ask for in our disclosures is information about how the measurements were undertaken, what sources of data were used, so that there's visibility, the ability to make comparisons between companies and to ask questions about why the choices were made. And that's really, really important. But I think the other thing that's really important in this space is that sometimes when people ask the question about, oh, what about the quality of the data? It's often very quickly followed by an observation that because there is a need to estimate and a lot of it's forward-looking, you shouldn't ask for the information because we're not definitely sure that it's, you know, exactly correct. And what we heard very, very strongly in the feedback that we got on our exposure draft is that investors know that things like Scope 3 will require the use of estimation. But having a good estimate of what the Scope 3 emissions are is still a massive step forward and still a very helpful piece of information relative to not having that information at all. So I think we need to acknowledge that sustainability reporting is quite new. It is a journey. We're going to need to have estimation. We need to have good assurance to support it, but that it shouldn't be a reason not to ask for people to get started on the journey and to get going. And I think that's really, really important.
Great, thanks, Sue. We're running out of time, but Panos, did you want to add quickly something on that?
Well, I would agree that we're probably years away before we have the capacity and the ability to really have a good estimate of what the impacts of a company operating far from Europe. Obviously, assessing sustainability, it requires a lot of information and some expertise to interpret that information. We're quite far from that. We see that with CBAM, the implementation of the carbon border adjustment mechanism, and what is going to be using as default values for the measurement of Scope 3 emissions for several countries. We don't have that robust nor the credibility of the certifying bodies in certain countries that we can rely upon. So default values will be for the beginning. I think we're probably more than 5 years away from having any reliable data that we can then present. So again, judging how sustainable a product is, requires quite a bit of expertise, and you need the granularity level to understand the intricacies and the production process and what truly impacts the production.
Okay, thank you very much. And well, we're nearly out of time, so I'd just like to thank all of the panelists for a fruitful discussion. I think a very interesting topic this afternoon, and also hand over to George. Thank you very much.
Thank you, everybody.
Thank you.
Bye-bye.
Thank you, Nina, and many thanks to all panelists. I think we had a vivid discussion, and actually this is one of the features of this conference. This conference is supposed to shed light on the challenges and not just praising ourselves. So many thanks for your insightful comments.